Hey everyone, Kevin here. Back on the set y'all love so much to talk about the stock market. Well, let's do just that. Mark Cuban says, right now, don't get greedy. This is like the 1990s tech frenzy. Others say that no, this time is different. But there's one thing I think we can all agree on. The stock market has been nuts, and we are about to experience insane volatility surrounding Q2 earnings. We've got COVID news, we've got vaccine news, and we're about to see footage from the new game Halo Infinite ahead of the Xbox Series X reveal. This makes me nervous and excited. Excited for Halo and nervous about everything else. This video is going to be concise but detailed. Here's exactly what you're going to get in this video, and remember, when you see this set, it's education only. We're not focused on news in this set. Number one, what's happening and why are valuations so nuts? I'm going to give you a very quick primer on this. This is very, very important. Number two, I'm going to talk about the dangers and the choices that we have right now. Then, also very important, I'm going to explain my exact strategy to you, including my stock portfolio, which targets I have, like price targets for certain companies, which stocks I'm focused on, and how I'm diversifying my cash right now. Am I selling? Am I holding cash? What am I doing? Let's get started so you know what's on my mind as a long-term investor. Speaking of which, it sounded German, which I was born in Germany, but anyway. Speaking of which, if you are a short-term trader, remember, do the opposite of whatever I say. Because it seems like when I sell a stock, it skyrockets the next day. And when I buy a stock, it goes down the next day. So there you go for all of y'all traders. But for those of you medium and longer term traders, I've made substantial profits over just the last 4 months. Not to brag, but the profits are over 7 figures, which for my portfolio is a big chunk. It has been absolutely insane, and yeah, it also makes me nervous. But judge me on my long-term success. Get your life insurance in as little as 5 minutes via the link down below. Get 2 free stocks via the link down below when you deposit just $100 with Webull. Check out my new YouTube course and, of course, my real estate investing course, links down below. And let's get started on this. Okay, let's first talk about something that we're not hearing enough about. We know that the Federal Reserve started bailing out the corporate bond market, which led to a lot of enthusiasm in the stock market. But enthusiasm doesn't create money. How much money did the Fed actually invest into the corporate bond market so far? Because we all keep saying the Fed's bailing everything out, right? Well, let's look at the numbers. The Fed injected $1.3 billion via corporate bond purchases. We'll call those C-bonds. This led to a lot of enthusiasm. Obviously, the Fed started buying bonds like crazy at the bottom of the market, starting on March 23rd and again in April, in early April. This was good. Yes, it helped the market. But people need money to be able to invest in the stock market. And the reality is, it's becoming more and more clear that over the last 3 months, a lot of the $200 billion from the Paycheck Protection Program money went to businesses, which are now over like 87% open, to pay worker payrolls. And guess what the bosses can do? They can now take, if they want, and I'm assuming a lot of them are doing this, a substantial portion of their payrolls or payroll coverages via the Paycheck Protection Program, basically free money. They're able to take a lot of free money and potentially put it into the stock market. $200 billion went to the PPP. A lot of that money was not needed by a lot of the companies that got it. And a lot of this money hasn't even been allocated yet, which means it's available for companies to spend on stocks. And when I say it's not allocated yet, I mean that companies might have gotten their check and then realized like, oh, our business is operating as usual. What do I do with all this extra money? Well, we're not going to give it back to the government. Obviously, this money comes from the Fed indirectly, but it's flowing through the PPP. There is still an additional $110 billion that hasn't even been sent to companies yet for the PPP. Look at this compared to the magnitude of the Fed buying corporate bonds. It's like this was literally just the signal going, yo, y'all, buy stocks. And then this was, we're bailing out the people and businesses. No, you're giving money to wealthy people or businesses. Yeah, there are going to be probably, a lot of restaurants and businesses that need this money to survive. But let's be real, when lawyers and accountants and celebrities and rich politicians are getting PPP loans in the neighborhood of millions of dollars to cover their payroll, come on. We know a lot of this is going into the stock market. Here, let me put it a different way. During the first or the second quarter here, when the PPP money came out, I don't know, but somehow a same $200 billion happened to inflow into hedge funds. And hedge funds ain't people like you and me buying stuff on Robinhood, okay? Big money is going into hedge funds, and it's coming from somewhere, and it ain't from the $1.3 billion in Fed corporate bonds. Then we've got about $150 billion that went out in stimulus checks, right? Okay, fine. We don't know how much of that actually went to, the stocks. I'm sure a portion of it did, and a portion of it went to actually help stimulate the economy. Fine, I get that. But what about this below this line here? This is really interesting, and it's something you've got to pay attention to. $6 to $10 billion, folks, this is really important, per month. $6 to $10 billion per month is going to mortgage forbearance, and that's backstopped by the Fed. Banks pay the first 4 months of missed payments, and then the Fed swoops in and pays the rest. If you have a $2,000 a month mortgage, you skip it for a year, you have $24,000 more that you can invest in the stock market. Meanwhile, you only have to pay that 24 grand back at the end of 30 years. It's literally like an interest-free loan. It's nuts. That's why I made a video saying rule change for mortgage forbearance. I'll link it down below. I'll link it up here so you can watch it. Put it in another tab, watch it, take mortgage forbearance, take car forbearance, take credit card forbearance. Folks, this is free money. Take the forbearance. Unless you're planning on buying real estate within like the next, 3 to 6 months, maybe don't take forbearance. But you should take my real estate investing course because I'll teach you step by step the psychology of investing in real estate. Anyway, here's the scoop. I've run some numbers and my estimates are that about $6 to $10 billion per month are being basically injected into the economy thanks to mortgage forbearance alone. That doesn't even consider credit card forbearance. It doesn't consider student loan forbearance or whatever other kind of forbearances there are. This is solely mortgage forbearance. And my guess is a good chunk of that is literally going into the stock market. Because again, people have a choice between savings and they have a choice of the stock market. And right now, the stock market looks sexy. Then you got $6 billion a month per month. And this is created by the Pandemic Unemployment Assistance Program, basically the $600 per week in unemployment boost. $6 billion per month is the money that's being injected into the economy thanks to the Pandemic Unemployment Assistance Program. That's the $600 per week. It's less than the mortgage forbearance, which my guess is anybody who owns a house, which people could be unemployed owning a house or real estate as well. My guess is that people owning real estate probably are more likely to put their money in stocks because they're already exposed to owning assets. This is like what I talk about in my Money and Stocks program, where I talk about the psychology of building wealth, the psychology of building assets, and the psychology of investing in stocks. It's a really, really good program if you have not yet checked that one out. Remember, you can bundle coupon if you want to have multiple programs. Then we have a question mark for the future of stimulus that's yet to come, which this is already being somewhat built into stock prices as people are sort of bidding up the stock market, expecting more stimulus to come. But what does this mean now? What choices do we actually have when we're looking to buy stocks, and what should we be buying? Well, let me talk about the choices, and then I'm going to talk about what I think we should be doing. Here's the reality. You're not putting your money into savings right now. You're probably not putting your money into bonds right now. Maybe you're buying real estate, and the real estate market is going nuts. It's doing very, very well. But when it comes to stocks, you have three main choices. You could buy the classics. You could buy the recovery stocks or potentially value stocks, or you could buy growth. Classics are things that are kind of boring. I personally think they're boring, so I'm sorry if I'm offending you. Beverages, Costco. Look, Costco did great in March, but then it kind of fizzled out. Procter & Gamble, Kimberly-Clark. These are down about 3.7% year to date. You can invest in utilities. These are down about 8.8% year to date. Or you could buy into banks like Chase and Wells Fargo who are absorbing the bulk of this disaster. They're down about 30% year to date. The problem is these aren't sexy and the prospects for long-term growth just ain't that great. So if you got a long-term time horizon, maybe these aren't for you. Otherwise, you could buy yourself AT&T and sit around $30 per share for the last 3 months. They've done like nothing. They do pay a 7% dividend though. Instead, you might be tempted by the value stocks because maybe you read Warren Buffett's biography. Maybe you learned about Charlie Munger and you said, you know what? Oh, here's a cigar butt. It's called Cheesecake Factory. Here's a cigar butt. It's Dave & Buster's. Here's a cigar butt. It's an airline like American Airlines, which is loaded up in debt. These companies suck during a pandemic, but let me see if I could get a little puff out of them and then we'll chuck them because they've got a very real risk of going bankrupt. Well, that is an option, and these did really well in June. If you bought these in like April and May and you sold them in June, hats off to you. you did very well. But if you didn't, you just slid right back down the mountain thanks to, well, the whole, second wave or continuation of the first wave, whatever you want to call it, you got screwed, okay? There's also a huge opportunity cost leaving money in these companies right now because they're recovery in value, but those are really only good when the recovery actually starts, right? So you've got this opportunity cost of losing money by not being invested in things like growth companies. Growth is where the money is right now. Think Apple, Microsoft, Shopify, Etsy, Amazon, Tesla. These are the companies of the future. Except what's happening with those stocks? Well, they're obscenely expensive. It's kind of like going crazy right now, and everything feels like it's going parabolic. For example, last week, Netflix climbed to almost $550 per share, and as soon as they reported earnings, lost about 15% in share price as they fell to $470. Sure, they've already rebounded a bit, and they're right around $500 now, at the same time as Tesla broke through $1,600 per share again. But what does this mean? It means that even though a lot of hope is priced into earnings, and even though when those earnings miss, because they almost basically have to, stock values are probably going to fall and we're going to see volatility, we might see a buying opportunity in these stocks because a lot of these stocks are going right back up. But wait a minute, come on, Kevin. The valuation for a company like Tesla or Peloton is insane. What's up with that? Why would I buy these? The S&P is trading at 28 times earnings. That's almost twice the long run of about 14.8. Well, wouldn't any little bit of bad news just make the market overreact and people sell out? It's so frothy. Well, the simple answer is probably for a very short period of time, if at all, because right now it seems like the safest thing to do is bet into companies that have no bankruptcy risk, which means even though these valuations are nuts, I think people are plowing this money that we talked about on the whiteboard into companies that are not at risk of going bankrupt during a pandemic, and they're going to do well in the long term no matter what. Yeah, does that mean for the next 2 years we might be trading sideways? Fine, but at least people see this as a way to store their wealth in the meantime. This creates a problem because it makes it impossible for fundamental investors like me to actually care, to actually feel good about these values. It's almost impossible to buy. And that's why we're going to talk about my price targets and my strategy now. Starting immediately, I'm going to park excess cash into a new M1 Finance portfolio starting this week. And if you're wondering about the 1337, don't worry, I'm going to talk about that in a moment. It's not dead, it's still phenomenal. But there's a specific strategy, so hold your horses. Starting immediately, I'm going to park my cash into this portfolio, which we're going to put right here. This is what I call the Meet Kevin basket. The Meet Kevin basket portfolio is where all of my extra cash will go as I make money. So that way I'm kind of dollar cost averaging into this, obviously, because you don't get paid instantly. You get paid like once a week or whatever. As I make money, my money is going to go into this. Again, you could see this portfolio by going to metkevin.com/basket. It's not meetkevin.com. I know. I got to fix the marketing on that, okay? Anyway, basket. Here is why. My goal right now is to balance my portfolio and try to mitigate risk with some of the cash that I have because I don't feel comfortable about overpaying for certain companies right now. Instead, and you might think that some of these indices are overvalued. Fine, let me get through this and you'll see the strategy. 35% of my, well, first of all, my cash is going into this portfolio. 35% goes into QQQ. QQQ is the NASDAQ, so 35% goes into that. One of the reasons I love the NASDAQ 100 is because I get exposed to my favorite tech stocks, but I also get biotech without having to pick them. I don't know much about pharmaceuticals, but I do believe that the NASDAQ will do very well continuously going forward and in the long run. So worst case scenario, I don't mind holding my cash in the NASDAQ. Then I'm going to balance this by putting 25% in the Russell 2000. Now this has to do with smaller cap stocks compared to, the Goliaths that are, like the Apples or the Teslas or whatever. But you get a lot more recovery exposure in the Russell, like exposure to restaurants, retail, or hotels without having to pick a company that might potentially go bankrupt. Then the remaining 20% and 20% is going to be evenly split into a Dow index fund and an S&P 500 index fund. You can see exactly which fund I chose by going to mettkevin.com/basket. Now, here's my expectation. I don't think we're going to see these indices in total decline realistically more than 10%. Even if they go down 20% in a double dip scenario, which I think the odds of that are low, of them dropping 20%, the odds are if I park my cash in them now, they might run up another 5, 10, 15% before falling anyway. So, if I dollar cost average into these indices, I should be okay with my cash. And even if I end up losing a little bit in the short term, there is a better thing that I'm going to do with the money if we see a crash. And I'm going to talk about that in just a moment. On red days and before any kind of crash, what I'm going to do is I'm going to put money into the Meet Kevin 1337 index. This is the one that I've been talking about for a while. These are my favorite 48 stocks right now. These are the ones that I've handpicked. I don't have any pharmaceutical in here because I'm clueless about these, but I've also weighted my favorites much more heavily. So for example, at the top, you'll see things like Tesla, Amazon, Apple, and Shopify, and Lemonade. And then towards the bottom, you'll see things with like 1% and 2% allocations like Home Depot, JP Morgan, Disney, Wynn, Dave & Buster's, and even Nikola is in there. Which Nikola, how many of you saw my videos saying Nikola was going to get spanked as soon as they said, all right, all the next like 50 million shares are now available to hit the market and people are going to start dumping them? That's exactly what happened. And Nikola's down like 20% again today. It's at like 38 bucks. I picked up some Nikola this morning. Okay, so the Meet Kevin 1337 index fund. And yes, that does mean LEAT in gamer speak. This you can look at by going to mettkevin.com/1337. So 1337. I've kind of explained this, but I haven't explained the strategy. I buy this fund on red days. So when I have cash available, I put it into this. When I have cash available, the Meet Kevin index, right, or the basket, right? The basket gets my cash. On red days, I move my money, some of my money, just a little bit. I kind of nibble into the 1337 index fund. Now we get to the part where I want to back up the truck and load up on my favorites if we see a crash. If we don't see a double dip, fine. I'll just keep buying this on red days and I'll keep putting my cash in the other one. But if we get some crashes and we get these stocks falling below my targets, I'm going to go heavy on these. I'm going to give you my targets, but let me show you this first. These are my hand-picked stocks, which you could see these. This is the Meet Kevin hand-picked portfolio. You could see these by going to mettkevin.com/July 2nd. That's when I last changed the allocations for this. It's a lowercase j, so July 2nd. Whatever, you'll figure it out. There's a link down below for it as well. So, mettkevin.com/July 2nd. These are my hand-picked stocks. Obviously, this is where I have most of my money with a ton of it in Tesla. Over 2,000 shares of Tesla are in there. I really believe in Tesla. I don't know if that came across. But anyway, here are my pricing targets. And I'm backing up the truck if we get a crash, and whatever kind of crash we get, or if we get bad earnings, like on an individual company gets bad earnings, I'll take my cash out of the index funds, which means, yes, I'll sell the index funds. I'll leave my 1337 alone, and I'll put the money into those individual hand-picked stocks. So that way it's kind of like my cash is working for me while I'm looking for other investment deals. If I find a good real estate deal, I'll take it out of the index fund and I'll put it into real estate. If there's a good opportunity in stocks, I'll take it out of the index and I'll put it into the hand-picked stocks. My price targets. If Tesla drops under 1,100, I am backing up the truck. That means I'm loading it up, right? It's a picture, semi-truck, beep, beep, beep. Okay, come on, bring it in, bring it in. I want those shares, okay? Etsy under 90, Apple under 320. Redfin under 32, Peloton under 50, Lemonade under 65, and Nikola under 30. I did say that I bought Nikola today at about 39, but that's more of a nibble. Sometimes I'll nibble on stocks as well. And usually what I'll do is I'll just go into my 1337 index and I'll buy a little bit more of Nikola. And then that way the next time I put like $5,000 into, let's say, the index fund, it automatically kind of rebalances it for me. So that's one of the reasons I like M1 Finance. I will be real though, I also do buy stocks with Robinhood and Webull, Webull really lets you get in after hours. Like I bought Netflix at $4.68 on the day of earnings, which was an after hours buy. And now it's at $4.96. I'm not trying to pat myself on the back for that. I'm just saying thanks, Webull, for letting me trade after hours so well. You can't do that as well with M1 Finance, but definitely get your 2 free stocks with Webull. But here's the thing. If we do not see a crash happen, and I can't buy these individual hand-picked stocks anymore, I'm probably not adding to them. I might nibble into them if I see them drop, but unless they hit those targets, I'm not backing up the truck. Instead, I'm really waiting for a stock like Dave & Buster's, which trades under ticker symbol PLAY. I'm really waiting for our recovery to solidify and for us to see that Dave & Buster's is not going to go bankrupt. If they get into the Main Street lending program, then they're certifying that they're not planning to go bankrupt. But the Main Street lending program is not disclosing any information for a year regarding participants. That's stupid, that's dumb, and it makes me sad. But anyway, there you have exactly what I'm doing with my money right now. I'm, again, also writing offers in real estate, but now you know what I'm doing with my cash, you know what my plans are, and I think I'm good no matter what happens. If we get a big crash, I can shift from index funds into my favorites, especially since I'll take advantage of those targets. Am I going to sell anything to sit around in cash? No, because I just don't believe in the double dip as much as I believe in being able to individually pick crash stocks from the index money. So that's my POV, not financial advice. This whole thing is just entertainment only. And if you want to learn how to make entertainment only videos, make sure to join my YouTube course, which does launch on August 10th. It is on pre-sale. Use the coupon code, join that program, and I cannot wait to see you there. Thanks so much, and we'll see you next time.